And welcome. This is your Friday afternoon MEM Edge show. And of course, this is the show where we bring you where the action is in the broader markets. Not a lot of constructive action, but certainly, as usual, a lot taking place beneath the surface. And we are going to get to that. I'm going to share with you where we closed the week. Take a look at some of this sector rotation that is shaping up a little bit, and then beyond. So first up, I'm going to share with you some of the headline news that drove price action in the markets last week. And certainly front and center on Wednesday, the Federal Reserve did release their notes from their latest meeting in July. And it was during those, really looking at those notes very closely, it was revealed that most of the Fed governors feel that we may need more rate hikes, that inflation is not at all near their 2% target rate. And so that, of course, pushed an already weak market down. And it also pushed already rising interest rates higher. So we did see the yield on that 10-year Treasury bond continue to rise. I'll share with you a view of that, but also a comparative view of how those rising rates are impacting the Nasdaq. Also, we did see a report earlier in the week. Actually, it was released at the end of last week, but it didn't really hit the headlines till this week, all about bank stocks. And there were Federal Reserve officials commenting on the fact that there were 10 stocks late last week, these regional smaller banks that were downgraded due to capital or liquidity reductions among them. So that in turn did push bank stocks lower. We'll take a quick look at that chart. And then also highly impactful was news out of China last week. And really what they talked about were industrial production and retail sales data were below expectations. So in turn, not only did we see the Chinese stock market decline, we also had fears of global economic weakness, which in turn did have energy stocks pulling back and other areas that I'll share with you as we move forward. Now, we did also see leading indicators fall. That number came out today. However, a closer look beneath the hood reveals that the economy is doing just fine. In fact, for third quarter GDP, it is currently on track for 5% growth. So quite strong, but that strong economy, of course, may get the Fed moving in the way of continuing to raise interest rates. So lots of cross currents, but at the end of the day, not a good week for the markets. Now, next week, we will see Fed Chair Powell speaking. It's going to be his Jackson Hole appearance. And as many of you may recall, that was a very impactful meeting last year. So we'll be on the lookout for comments from that. And then also August consumer sentiment will be released as well. So be on the lookout for that. Earnings season not quite over. We do still have some companies coming out. I'm going to share with you some of those names as well. So let's go ahead and take a look at those markets, see where we closed for the week. And here we are. This is a daily price chart of the S&P 500. And you can see that we are continuing to trend lower. This index was down a little more than 2% for the week. On this daily price chart, we can see this RSI momentum indicator trending lower below that net neutral 50. And also taking a look at these key moving averages as they began to break below these areas which had been support. This is your 10, 21, and most impactful 50-day simple moving average. A break below that 50. I did put out a Tuesday alert report signaling that a true downtrend was very much in place. And then from here, taking a look at the faster moving stochastics down here in negative territory as well. So we are, in fact, in a correction with this index. Now, what you want to pay attention to is going to be key areas of support or resistance. And I'm looking at this 4,300 level as this next key area of possible support. Many of you may recall the move above 4,300 back in mid-June was very cheered, and really a lot of people were very bullish. following that because this was a long-term area of potential upside resistance. So if we do see below that 4,300, I would anticipate non-negative impact among investors. So let's go ahead from here. I do want to share with you a couple of views of that Nasdaq. Now the Nasdaq was down a little bit more, 2.6% on the week. We're going to take a look at a daily chart here. Same dynamics, negative momentum indicators. Break below this key 50-day simple moving average. Quite simply, I've signaled here what you need to be on the lookout for to indicate that this current downtrend has reversed, and we are not in a position to even begin to look for that possibility quite yet. And looking here at a daily view of the Nasdaq with the yield on that 10-year treasury, that's going to be this thin line here relative to the Nasdaq. And it's taking us back to the end of last year. And you can see as interest rates advance, the Nasdaq has pulled back. Very clear-cut correlation. What took place here more recently, June into July, we could see interest rates were continuing to increase, but the markets were looking the other way. So more recently, of course, we've seen that dynamic come back into play, the Nasdaq pulling back as interest rates continue to climb higher. So from here, let's go ahead and take a look at those 11 sectors beneath the S&P 500 2-month daily price chart view with that RSI indicator, and then sorting in descending order. Now, from here, you can view that 50-day simple moving average. That's going to be this red line. And quite simply, we only have 2 sectors that remain above that key area of support. So let's take a quick look here. This is Energy XLE. This is that pullback on China's weak economic news, but it did rebound. And as we move forward, I'll share with you at the very least the price of oil. That's going to be one impact, but the other is we're seeing nice strong earnings reports coming out from select names in this sector. So we do have positive RSI, positive MACD, so looking very constructive, certainly relative to the rest of the markets. Now, let's take a look at healthcare. This is XLV, and you can see we've broken below near-term support, but we are still above that 50-day or MACD in positive territory, and that RSI just dipping below. And I'll share with you some sub-industry groupings in here, but by and large, it is large cap pharmas that are helping this index remain relatively constructive. So as we move forward, I'm going to share with you some of these weaker areas. I'm sure you're well aware, for those of you that are active investors, you'll know that technology. Now, interestingly, technology was the top performer this week. It was down 1.1% relative to 2.1 on the S&P 500. And this is something, of course, many of us are going to keep a close eye on, because ideally at some point in time, we are going to look for a leveling off of technology as well as other areas, with an eye toward eventually coming back into an uptrend. But at this point in time, not the case. And other areas to pay attention to as far as just breaking key support this week. This is the industrial sector, XLYI. And we did see, for instance, Deere came out with their numbers today, and other bellwether names that pulled back. I have a list of names that I'm going to be sharing with you. It's a segment called Should You Buy the Dip? And I'll share with you what to be on the lookout for to signal that it was just a mere blip, or is that stock in a downtrend? So moving right along, consumer discretionary here, falling further below this 50-day simple moving average, now has a negative MACD. And among the areas in here, Tesla, certainly a heavyweight, down 11% this week. The company is continuing to offer discounts and slash prices. Amazon down almost 4%. So certainly those two are going to be impactful in that consumer discretionary. Other areas also not faring so well in that consumer space. So let's go ahead beyond these 11 sectors, take a look at some of these sub-industry groupings. And I will add another. I use ETFs that are really quite powerful as far as helping define what's taking shape beneath those sectors, beneath the markets. Again, 2-month daily price chart view, and then sorted descending. So let's take a look. The US dollar trending higher. This is quite common as interest rates rise. In turn, this is, and very well could be, a reason that some of these mega cap names, particularly industrials, are seeing weakness. A rising dollar does reduce or is not good for these companies that export goods to other areas. And then also want to take note of the yield on that 10-year. Now, we did see it pull back a little bit today, but we did earlier this week get up above that 4.3 level. And at the end of the day, we are above this 4% level on that 10-year, which is highly impactful. So also another area that is really helpful as far as staying on top of sentiment among investors, and this is that volatility index, also known as the VIX or the fear index. So what we can see as we look at this daily chart of the VIX is it did get up to this 18.8 level. Now, from my work, anything elevated above that 16 is not good for the markets as it relates to that inverse relationship. So keep an eye on that VIX to really help keep on top of investors thinking as it relates to the broader markets. Now, Brent crude, I talked about it being elevated. It is now at $84 per barrel. I'm going to pull up a quick weekly here because while this oil price per barrel did fall this week, it is still in an uptrend on this weekly. We have this momentum on that MACD just entering into positive territory, but keep an eye on that. There is definite correlation with crude oil pricing and those energy names that I mentioned. Another area that I did want to share with you is the fact that small cap stocks really got hurt. They were down 3.3% last week after a tough week last week, finding support at this 200-day simple moving average. And small cap stocks are going to fare better when the economic outlook is constructive. We are seeing recession fears beginning to creep in. So that is being shown with that particular industry. Now, semiconductors and software both outperformed for the week. Here we are with SOXX, the semiconductor ETF. We had a nice sharp rally on Monday, and it did help a number of names fare well. And then today, up 0.5%, and this is due to earnings. I'm going to be talking all about this in my Sunday MEM Edge report. You can take a look at that by using the link below, because this semiconductor area really has been a winning area, certainly since this May release of NVIDIA's earnings and outlook. And NVIDIA is due to report in a little more than a week. So another area in technology that helped that industry group be the least underperforming and the best performing is software names, down only 1.5% relative to the broader markets. And again, a little bit of a 0.5% rally today, and then a nice rally on Monday. Now, does not mean we're out of the woods. We do still have negative momentum taking shape here. But another note is the fact that heavyweight Microsoft was down only 1.5% as well. So these are the areas from my work that I'm keeping super close eye on, very simply because they were the first to begin to deteriorate. So I am anticipating them to lead on that recovery side. Lots of names in here exhibiting positive growth, and they did potentially get ahead of themselves with this software ETF in an overbought position. So stay with me on this. Again, you can trial my MEM Edge report to really be kept up to the minute. So from here, a couple of areas that I do want to share with you, and that is, first up, we're going to take a look at a number of companies that really pulled back, in fact, rather sharply. So what I'm going to share with you are some of these names could be bought on their being overdone to the downside. And let's go ahead and take a look. Now, some of you are, if you're watching the markets closely, you will know that we did have news come out earlier this week. This is Cigna, CI is the ticker symbol, and that they were severing their ties with CVS. And take a look. This is yesterday on Thursday. Gap down, huge volume. And I do a trading room, a live trading room over at Simpler Trading. And yesterday, one of the individuals at that live session asked about buying Cigna on the dip, simply because this particular pullback yesterday really felt overdone, certainly given the news. So from here, what can be really helpful as it relates to should you buy on the dip is taking a look at an intraday chart. This is Cigna on a 15-minute chart, and I'll share with you what I shared yesterday on Thursday in that live trading room, and that is the metrics that I would need to see to tell me that it is going to continue to trend higher. First up here, we can see that the stock CI on the 15-minute got into an oversold position, and we can see the momentum shift here quite negative on that severe drop. As it relates to what to be on the lookout for to signal that super near term, remember, we're looking at an intraday chart, so this is not giving a more pronounced longer term view, but simply sharing with you what characteristics would need to shape up in order to give you confidence that there could be further upside. So today we did see a move above the 5 and 13 simple moving average. We did get that RSI into positive territory. This is going to be the most important factor. Now, we're not making a lot of money here. We are talking about a move from 273 to 276. This is more instructional relative to what to be on the lookout for to signal potential further upside, and we could see more into next week. So keep an eye on that. Another couple of names here that did experience pullbacks. I talked about interest rates on the rise, and what we did see was a pretty swift response. Let me see if I can pull up some names here relative to those that are going to be negatively impacted by higher mortgage rates. Here's DHI as an example. Many of these housing stocks pulled back very sharply as we saw rates rise, and in turn mortgage rates. So we also did see pullback in names that provide construction materials to these home builders. So first up here is BLDR, Builders FirstSource. The company had just reported very strong earnings back here, was in a very nice uptrend, and then got caught in that downdraft. So quite simply, I'll take us back to that intraday 15-minute price chart, and very same dynamics where the stock got oversold throughout the course of Thursday. And then on the open today, we did see a nice move in that first 15-minute, actually 30-minute period. And this stock did close above the 5 and 13 simple moving average. Now, let me just share with you very quickly from my work as it relates to having confidence, again, super near-term outlook. I am going to need to see that RSI get into positive territory, and we did see that. Now, you will be on the lookout, I will, potentially for a continuation rally, but again, this is for individuals that are more active in their trading style. Now, I did want to share one last name because it really did fall out of bed, and many investors thought not as warranted as it to deserve that. And this is Datadog, DDOG. They did announce earnings back here. Big turnaround. I had added it to my MEM Edge report back here during this nice uptrend. And then here we are with their recent earnings. We actually removed the stock in late June, but here we are with its most recent earnings. Huge drop here, very big volume, and here we are with the stock continuing to wedge higher. And once we can get up here in positive territory on the daily, that's going to bode well for a little bit of a longer term, but certainly we can always learn from this intraday price action as well. Also, I do want to share with you some other companies that did report earnings this week. and are looking quite interesting. A number of retail names, certainly Walmart among them. But let's take a look at ROST stores. They came out with numbers and they were quite constructive. They guided higher, and we can see this nice high volume as the stock broke above this flat base formation, positive momentum. And then another discount retailer here, TJX, also came out with constructive numbers, and this one actually had a gap up into a base breakout and a nice continuation rally, nice high volume. Of the two, TJX looks more constructive than ROST, but they both are looking quite interesting. And another couple of companies that reported numbers that are looking somewhat interesting. This is Bill.com, BILL. Now, this particular company does provide back office services for smaller companies, software company. And we can see, take a look at this daily bar here, and the stock did undercut it this recent low and then closed well above the high of yesterday. Now, this is known as a bullish engulfing pattern. I don't see anything a lot more in the way of super constructive quite yet. I will need to see that RSI get into above 50 and also get that MACD black line up through the red with a price move above that 50. I know I'm asking for a lot, but when that does take place simultaneously, I would have more confidence as it relates to further upside. Another company here that did report earnings and they came in well above estimates. This is H&R Block. They are certainly one of the number one tax preparers, and we can see this gap up on very big volume and a nice continuation rally subsequent to that. The company did come out with earnings above estimates, and it was all about the company cutting expenses, which helped their profit margin, and you can see it's being propelled into a nice uptrend. Last two names here, I did want to share both Walmart and Target and just give a sense of what's been taking shape here. Walmart did report their numbers and the stock really sold off in response. And this is despite showing earnings and sales above estimates and raising their estimate. Now, today, I think people thought over the report over the week, over the night, and we did see a nice 1.5% rally today in the stock. But let's take a look at Target, which also came out with numbers, and you can see this gap up in response. And Target came out with sales that were below estimates, and their outlook, they guided lower. So in essence, what we are seeing is companies that are priced for perfection, and this is something we've seen this earnings season where they're sitting up here at near-term highs, and they come out with numbers, they are still not trending higher. Now, of course, broader market pressures are going to be at play there as well, so we can't really say that it's all about the earnings. But from here, let's take a look at a couple of names that are due to report next week with that dynamic in mind. First up here is Ulta. This is a cosmetics and well-being type of brick and mortar company. And what we can see is this gap down. Now, this was all about weak numbers. It's going to be tough to say if they are what they may report next week, but it certainly is well below its peak in price. Be keeping an eye on this particular stock. Another software company that is due to report next week is WDAY, and it is also holding up here. But if we look at a weekly, it is at a near-term high, so we could see weakness there as well. One last name, a retailer that's due to report next week is Williams-Sonoma, WSM, pulling back into that release. So we'll be seeing how they fare next week as well. Now, given the current dynamics in the markets, this is an ideal time to put together your watch list. Have that list so that when the markets do turn, you are well prepared to potentially participate. Now, my watch list is going to be primarily populated with stocks that came out with really strong numbers. This is Boot Barn, BOOT, already had a rally going into the release. And then this pullback is all about downward pressure in consumer discretionary, and then also the broader markets. So a couple of other names that I have on my watch list that came out with good numbers and are pulling back, but not quite as much. This is Uber, UBER. You can see this pullback, but more recently it is seemingly leveling off. Keeping an eye on that RSI, if we can get into positive territory and then experience that MACD crossover in line with the broader markets faring better. And then another name for that watch list is Sprouts, SFN, and this is a company. Take a look at that RSI trending higher. We're now back above these shorter term moving averages, on the lookout for a black line up through the red to confirm a new uptrend taking shape there. I am going to share with you another couple of items here. We talked about semiconductors that were down quite a bit less than the broader markets. And I did want to share with you the fact that semiconductors using, I use William O'Neill's service. I was for 15 years in the institutional department, and I worked certainly with Bill O'Neill and others in sharing his approach to the markets with professional money managers. And as such, the semiconductor industry using that service is broken down into three categories. It's going to be semiconductor equipment, semiconductor fabless, and of course, the last is going to escape me. But what I did want to share with you here is a couple of names that are in the semiconductor equipment space. Those are the ones that fared the best this past week. This is VECO, VECO, and we can see that the momentum is still in positive territory there, and the MACD is also in positive territory. So these names that are holding up relative to not only the semiconductor group, but the broader markets are going to make my watch list. Another company that came out with numbers today in that semiconductor equipment space is Applied Materials, AMAT, and we can see that today's 4% rally has put the stock in a potential area where it can close above these moving averages, get that RSI up there in positive territory, and a MACD crossover. Now, this is all about, again, formulating that watch list so that when the markets do come back into an uptrend, you can participate. Next up here is Oracle. I'm pivoting over to that software group, and this is the company's gap up on their earnings release, and then subsequent to that, news about their AI and their move into that area. So we can see relative to other software names and that group, it's holding in quite well. The RSI above 50, look out for that black line up through the red on that MACD would be quite constructive. Another name that we can take a look at here, also AI driven, also earnings driven as well, is Adobe, ADBE on that daily. Now, we can see that it is beginning to dip into negative territory with that RSI, but still finding support above that 50-day. And certainly you can compare that to the overall software group using IGV. And again, these names that are holding up and withstanding downward pressures taking place elsewhere will often go on to lead once the market pressures lift. Now, I did want to share Microsoft with you. This is a decline in response to weaker than expected earnings. And you can see, no doubt, it's in a downtrend, finding upside resistance at this 10-day simple moving average. So from here, you will want to have a plan, certainly for Microsoft and the other mega cap names that could easily come back into play. And I will go ahead very quickly here and mark up those characteristics that would signal that this particular downtrend has reversed into an uptrend. So I'm going to take us back. It's not as pronounced, but it certainly tells the story back here in March. And this is when we added Microsoft to my MEM edge list. And it was all about these dynamics, the move back above these shorter term moving averages, RSI in positive territory, and that MACD crossover foretold a nice lengthy uptrend. And that's it for this week. Everyone have a great weekend. I'm going to look for you again here next Friday afternoon. I just remembered that third sub-industry grouping among the semiconductors. So I talked about semiconductor equipment. That is the most constructive area into the end of last week. We also have semiconductor fabless. And then that last one is the semiconductor manufacturing industry.